Good afternoon and welcome to Sarity Partners Q3 2025 Market and Economic Outlook. I am happy to be joined by my colleagues, Amita Schultes, PhD, partner in our OCIO practice in our New York office, and Jim Leventhal, partner and our chief equity strategist, also in our New York office. Before we get into our presentation and let Jim and Amita take us through the global markets and economy, a couple of housekeeping items. One, thank you to all of you who have submitted your questions in advance. We've incorporated that feedback into our presentation. We will not be taking any questions on the call. If you have follow-up questions that we didn't directly address or hit on during the presentation, please reach out to your Sarity Partners advisor. With that, we'll get started in our presentation. As we surpass the halfway mark of 2025, I want to take some time to, one, go through a little bit about what's transpired in the global markets and economy in the first half of the year, but more importantly, focus on our outlook for the second half. And the way that we would frame it is the following. There are a number of tailwinds both to the market and the economy that we're going to take you through over the next 30 to 45 minutes. But we also want to balance that against some of the risks to both the market and the economy as we head into the second half of the year. So, what are the potential tailwinds or upside surprises that we see for the back half of 2025? The recent passage of the One Big Beautiful Bill provides the opportunity for additional stimulus into the economy that could support spending and growth. It's likely that the Federal Reserve will move from a neutral, or some could argue hawkish position, to a more dovish position and ease along with other global central banks that again provides upside to the market and the economy. AI spending continues to be a key driver of capital expenditure and corporate profits, and we do not see that trend subsiding in the back half of 2025 or even into 2026 and 2027. And that helps support what we would call a robust and sturdy corporate growth environment drop back. But we have to balance that against what some of the headwinds are, and we'll go through some of the risks to the market during this presentation. The passage of the One Big Beautiful Bill calls into questions high fiscal deficits here in the U.S. and how that will impact bond yields. Tariffs both could be a headwind to consumer income and spending, as well as the uncertainty that we've seen through the first half of the year. And finally, something that Jim will touch on in the back half of the presentation. We talked a lot about this, but index concentration around the high-profile name, the so-called Mag 7, is still a concern for the markets. So with that, I'm going to pass it to Amita to take us through the state of the global economy.
Thanks so much, Tom, and happy summer to you. We can move to the next slide. It is summer carnival season, and roller coaster ride seems an apt description of the first half of 2025, both in terms of equity market returns and in terms of trade policy. In less than 90 trading days, the S&P 500 went from an all-time high on February 19th to a 19% decline on April 8th, and then back up 25% to an all-time high at the end of the quarter. While it's been an uncomfortable and sometimes wild ride, what we've experienced has turned out to be somewhat of a classic correction. The market's now fully recovered as we've entered into the third quarter. As it relates to the asset class returns that you're looking at on this slide, it's been a good year so far for global diversification, both for equities and for bonds. You're looking at the year-to-date returns on the right-hand side. You'll see towards the top of the chart, international and emerging markets equities in the up 15 to 19% range so far. This year, a weaker U.S. dollar has served as a tailwind for developed international market returns. Global bonds are up at 10% so far this year, and almost all classes are in positive territory, with the exception of just one, REITs, at a negative 0.1% return. And this is a shift from last year. You may recall last year, U.S. large cap and REITs were at the top of this stack. International equity was somewhat lower. And then global bonds were all the way at the bottom at a negative 5% return last year. Um, Going back to this year, you'll see that year to date chart on the right hand side. Very top line is gold. A lot of strength earlier in the year in gold due to uncertainties around trade policy and geopolitics. Gold has come back down to moderate turns in the second quarter, but as part of the commodities complex, it is certainly seen as a hedge against inflation, currency debasement, and policy missteps. But all in, markets seem to have brushed off concerns about deficits and tariffs so far this year, and the equity and credit indices are entering into the third quarter with what seems to be somewhat of a high level of optimism. One of the reasons for optimism is the passage of the One Big Beautiful Bill Act and the incremental stimulus that is expected to come along with that act. You can see on the next slide some more information about that. As you likely know, that bill passed Congress and was signed into law by the president on the 4th of July. It's expected to provide incremental stimulus, but also impact the deficit. And for those reasons, we would put the bill in both the tailwind category and the headwind category. As the Congressional Budget Office scores it today, the bill is expected to increase the deficit by approximately 3.4 trillion over 10 years. There are some nuances, however, in that the budget scoring process has that we think are worth mentioning here. As you would expect, the extension of the tax cuts from the 2017 Tax Cuts and Jobs Act, combined with the additional tax cuts in the new bill, will bring in less tax revenue than if the current law expired at the end of the year. However, there is a supply side economic dynamic at play here. When you reduce tax rates, you can potentially unlock incentives, meaning there will be more capital for individuals and businesses to invest and produce. GDP can grow, the economic pie can get bigger, so to speak. If that happens, when you apply even the lower tax rate to the larger economic pie, tax revenue could potentially rise and rise to a level that is higher than what would have been achieved with a smaller pie and a higher tax rate. Another nuance that isn't fully considered in the current budget scoring process is the potential tariff revenue expected from the trade deals that are currently being negotiated by the Trump administration. Now, as we've seen, these negotiations are very fluid, both around tariff rates and the duration of tariffs. And as such, it's difficult to estimate how much tariff revenue might come in. But to give a sense of the magnitude, the current higher tariffs will raise around $100 billion in revenue for fiscal year 2025. And remember, that's ultimately what Trump's plan is, to replace tax revenue, both on the individual and corporate side, with tariff revenue. So how the math works out is very important. There are projections indicating that the equation is in fact unbalanced, meaning that tariff revenue could offset the revenue decline and deficit impacts of the cuts. But as we know, tariff revenue is still somewhat in play, and I'm going to talk more about that a little bit later. On the next slide, you'll see, importantly, there is a policy cyclicality to the bill, meaning first comes stimulus from tax cuts, then comes austerity or cuts in government spending. It's this timing cycle that has created some concerns about growing deficits in the interim. Another way to think about the deficit is as deficit to GDP, a ratio of deficit to GDP. The current deficit to GDP ratio is expected to be at 6.3% in fiscal year 2025. The bill would lower that ratio by 0.2%. In the longer run, with tariffs as they are expected today, we could see that deficit to GDP ratio stay below 7% for much of the next decade. However, that's still an unusually large ratio for peacetime expansion. Historically, we've seen that deficits have somewhat of a cyclical quality in that they decline when the economy expands. That's because tax revenue increases and transfer payments for social benefits like unemployment insurance, for example, decrease. What's been interesting in the current expansion is the deficit reduction has not happened. This time, the increase in interest rates on government debt has placed an additional burden on the budget, as has the aging population. So there is some thought that large deficits are here to stay, and we just need to get used to them. The tariff revenue in this case becomes even more important. So let's see where we stand with tariffs today. You can see on the next slide that it seems the tariff roller coaster ride is not going away anytime soon. We're still putting tariffs in the headwind category. The 90-day pause, as you all likely know, that happened on April 2nd, tariffs expired on July 9th. And so far, only 2 trade deals have been announced, one with the UK and one with Vietnam. For others, the Trump administration is sending letters citing new tariff rates to be imposed after August 1st. The effective tariff rate on August 1st, considering all tariff announcements announced as of today, is 20.6%. That 20.6% effective tariff rate is the highest since 1910, so over 100 years. And what we're looking at are 30% tariffs on the EU, 30% for Mexico, 50% for Brazil, 20% overall tariff on Vietnam, with a separate 40% rate on so-called transshipments that attempt to capture Chinese imports that are coming through other countries. And then a sectoral tariff of 50% on copper, with more on the way for other sectors like semiconductors and pharmaceuticals, potentially. In our view, two of the most disruptive tariffs may very well be China and, perhaps surprisingly, copper. China because it's disruptive to supply chains, and copper because it's disruptive to production costs. In terms of supply chains, what we're seeing are stresses on supply chains being elevated, but still somewhat contained for now. It is clear, however, that manufacturers are trying to move supply chains out of China. As U.S. imports from China have declined, imports from India and Vietnam have increased. We've also seen China export substantially more to India and Vietnam in what looks more or less like a supply chain diversion. We anticipate if the effective tariff rate on Chinese imports continues to be at around 40%, that businesses will continue to push for supply chains to be diverted away from China. In terms of the production costs related to copper tariffs, those tariffs will raise production costs for manufacturers, especially in industries that are heavily dependent on copper. So think of things like electronics and construction and transportation. Down the line, the hope is that the tariffs could lead to increased demand for more domestically sourced copper, which could cause an increase in U.S. mining activity potentially. But that's something to watch out for going forward. So that's where we stand with tariffs. How much are they expected to impact each of us in our day-to-day lives? On the next slide, you'll see some information related to this. The Yale Budget Lab estimates that 20.6% effective tariff rate that's anticipated on August 1st that I mentioned will raise overall prices by 2.1% in the short run. That equates in dollar terms to about an average per household cost of about $2,800. But the range is quite large. If you look at the lowest income decile households, they're expected to feel a hit of about $1,500 to disposable incomes annually, whereas the top decile earners are expected to feel a hit of approximately $5,700 annually. Importantly, however, that hit to lower income household accounts for nearly 4% of their household disposable income, whereas the hit to higher income households accounts for only about 1.1% of their household disposable incomes. Those relative percentages are expected to impact overall consumption numbers in the U.S. And you have to remember that U.S. consumption is driven by the top income earners. The top 10% of income earners are responsible for nearly half of all of U.S. consumption. So for these high earners, we don't anticipate that their percentage of disposable income will change dramatically. When you look at their household balance sheets, leverage rates are fairly low. Household wealth is fairly high. Equity prices have been rising, so they're feeling the wealth effect. In terms of which items in our shopping carts will get affected the most in the short run with tariffs, shoes and apparel get the biggest impacts. 44% higher shoe prices are expected. 40% higher apparel prices are expected. Food prices rise substantially as well. 4.1% increase is expected on food prices, with fresh produce rising up to 7%. Car prices also expected to rise to the tune of around 14%, which in dollar terms is equivalent to about an additional $6,800 higher price for the average price of a new car. So bottom line here, if you eat, if you're looking to buy new shoes, if you're looking to buy new clothes or a car, you should expect higher prices due to tariffs. And all of this, of course, will have an impact on GDP. The expectation is for a negative drag to GDP to the tune of about negative 0.9%. This is because while U.S. manufacturing output is expected to expand, it's offset by other sectors contracting, namely construction and agriculture. you would expect to contract. So, in other words, if enacted, the tariffs announced so far would create a headwind for the consumer. However, they would also generate tariff revenue for the government to offset some of the tax cuts. On the next slide, let's dig in a little bit deeper about whether tariffs can help the fiscal situation. As of June, tariff revenue is running at 326 billion annualized rate. Assuming that tariff rates stay as expected, the Yale Budget Lab estimates 2.5 trillion of tariff revenue over the next 10 years after accounting for some of the negative impacts to economic growth. I think it's important to remind everyone that the legality of the tariffs is still a major question. You don't hear about this a lot, but there is still a question about the legality of the tariffs. As you may remember, they were established under the International Emergency Economic Powers Act, the IEEPA. The Court of International Trade on May 28th ruled that Trump's invocation of the IEEPA to establish the tariffs is actually illegal. An appeals court ruling will allow them to remain in place while it deliberates the legality. And it's still going to take a few months more for the deliberations to conclude and the verdict be rendered. If the tariffs are deemed illegal, it's possible the government has to rebate the already collected tariff revenue. Now, President Trump could cite the powers of different legislation, most likely the act, Section 338 of the Tariff Act of 1930, which he used in his first administration, to install some of the same tariffs he has in place under the IEEPA. But that process to use Section 338 takes much longer and would extend uncertainty and market volatility in the meantime. But in the meantime, we are continuing to watch how tariffs are impacting inflation. So let's turn to the next slide and take a look at this. We would put this story with inflation in the tailwind category for now. The June CPI report from earlier this week showed prices up just a bit to 2.7% year over year. So not a big increase, but there was a lot of inconsistency across the subcomponents. And that's where the tariffs are visible. It's in the increase in prices of things like household appliances, apparel, and toys. And to us, the report really highlights that tariffs are being passed on to the consumer. It just takes time for it to get there. And we should expect higher prices to take time for two reasons. One, retailers are drawing from existing inventories to reduce overhang as they wait for more clarity on trade policy and tariffs. Remember, we saw this in the first quarter GDP print. It was a negative print, partly because businesses had pulled forward demand. They had front-loaded up on inventory earlier in the year, and now they're making their way through that inventory. Second reason it's taking some time for tariffs to hit the CPI report is that companies seem to be hesitant to fully pass along those cost increases, and instead are eating some of those higher costs and feeling the pressures on their profit margins so far. But all in, there seems to be pretty good evidence at this point that tariffs are boosting at least some goods prices. Other goods prices happen to be falling. Things like autos and airfares we see going in the opposite direction. But where we see inflation going from here is higher, potentially focused more on goods inflation and less on services inflation. Remember, if you look at the CPI basket, goods inflation is only about 36% of CPI. Services inflation is a much larger component at 64%, and services inflation continues to be in decline and has been muted over the past few months. There was a pre-submitted question about the implications of a depreciating US dollar, and I touched on that earlier in relation to international equity returns. Another implication of a depreciating dollar is that it presents an upward risk to inflation. A weaker dollar increases the likelihood that businesses pass on a larger share of tariffs to consumers. Now, a depreciation in the trade-weighted dollar would take a few months to show up in final consumer prices. We've seen some models showing a 10% depreciation could increase inflation by almost a half a percentage point this year and potentially 1 percentage point next year. But so far, so good with inflation so far this year. Another area of the economy that's in good shape in our view is the labor market. And we can turn to the next slide to take a look at this. Despite the tariff uncertainty, the labor markets continue to be in what we would consider to be somewhat of a Goldilocks position. Not so hot that it's causing wage inflation, not so cold that it's causing consumption to decline. And companies really appear hesitant to cut back on their workforces so far. The unemployment rate has been trending down, not up. We went from 4.2% down to 4.1%, well below still the longer term average of 5.7% when you look at data going back to 1948. So not a lot of hiring, but not a lot of firing either. We've seen solid new jobs reports over the past 2 months. Many new jobs were from what we call eds and meds, education and health services, and from state governments. Elsewhere, we've seen payroll activity be somewhat static, headcounts of entire industry shifting by only a few thousand people in either direction for several months in a row now. On the next slide, you'll see that there are areas where there's a loss of job openings. These are mainly in the federal government and small and medium-sized businesses. And we're also seeing an interesting shift in the labor force dynamic. Baby boomers are aging out, immigration is drying up. So you have fewer people entering the workforce, which means that a lower pace of job creation may be the quote unquote new normal for the labor market. But for now, businesses are not laying off workers. On the next slide, you'll see a reminder of what happened in 2020. It's likely that businesses also recall the lessons of 2020 during the COVID pandemic when they let people go en masse. Payrolls dropped by about 20 million in just 2 short months. But once the health situation settled, it took over 2 years to hire those 20 million back, all while wages were climbing fairly rapidly. So companies had to pay more to bring back their workforce. This time around, it seems like employers are trying their best to wait and see. One of the things they're waiting for is to see what action the Fed is going to take. On the next slide, you can see that we would put Fed action in the tailwinds category. The Fed is expected to join many other global central banks and go back to cutting rates. The timing and magnitude has changed somewhat, however. The market expects fewer rate cuts as economic data remains relatively strong. As recently as April, investors thought the Fed would cut 4 times in total in 2025. Now we're down to expecting just 2 cuts in 2025, each at 25 basis points, the first of which is most likely to occur in September, the second one perhaps in December. But to this point, the Fed seems to be in sort of a position where they're waiting to learn more about the effects of tariffs before cutting. However, we are starting to see some differences in opinions beginning to develop within the FOMC. Some members believe that if inflation remains near current levels or moves closer to the 2% target, it would be appropriate to cut rates. Others are closely monitoring any signs of a weakening labor market as an additional catalyst for cuts. As I mentioned, we're looking at September and December as the most likely timing for cuts by the Fed. At that point, we think the Fed will have a little bit of a better sense of what the inflationary impacts of tariffs are going to look like, and certainly we'll have more labor market data at that point as well. But what the Fed decides to do and the timing of when the Fed acts will clearly impact the bond market. So let's look at the bond market next. As expected during the quarter, the 10-year Treasury yield was more or less range bound in the low to mid 4s. It went from a low of 4% to a high of 4.6%, but ultimately finished close to where it started at 4.2%. We anticipate that a slower growing economy in the second half of the year could drive this yield to the bottom end of that range and perhaps even pierce below that 4% lower band threshold. We also expect a steeper yield curve and a full return to the more usual upward sloping shape of the yield curve as well. While Treasury yields were range bound, credit spreads moved materially during the quarter. They fell from 4.6% in early April to less than 3% at quarter end. Worth noting, we have seen some less than stellar Treasury bond auctions at the end of the second quarter. This may be an early indication that demand for U.S. Treasuries is waning due to lack of fiscal discipline. It's a little bit too early to tell on that front, however. And the last tailwind I'd like to talk about is one that Tom alluded to at the very beginning, artificial intelligence and the associated boom with that. You can see on the next slide that with the adoption of AI still relatively limited, we think the trend is just getting started here. And there is meaningful implication on the investment front, partly because of the amount of power that's required. We were already seeing an increase in the demand for power with electric vehicles. That's gotten a further boost now with the advent of AI. A single chat GPT request can require 10 times the energy of a standard Google search. It's estimated that training large AI models like GPT-3 can consume the same amount of electricity as is used by 130 homes in the US per annum. And there's a need to build more data centers with their own significant energy needs. Data center investment is running at a $600 billion annualized rate, which equates to a full percentage points in real GDP growth terms. On the next slide, you'll see, in addition to having meaningful impacts on investment in energy, AI is and will continue to, in our view, have meaningful impacts on productivity. We see productivity gains picking up steam over the next few years. The Census Bureau puts out a really interesting survey periodically about business trends and outlook. They ask a number of questions, two of which we're touching on here. One, has your business used AI in the last 2 weeks? And two, is your business planning to use AI in the next 6 months? Over time, the percentage of yes responses continues to increase, as you can see. So we are seeing more adoption. But also telling, we think, is that overall level of usage is still fairly low. And in our view, adoption is only going to increase from here. There's a good study that McKinsey put out that found that while the use of AI is pretty widespread among businesses in one or two functions, there's still a vast untapped potential to get businesses to adopt widespread use of AI amongst all of their operations. So as I mentioned, we think we're just in the early innings of AI-related growth. And one more slide on AI. The use of AI could potentially impact the employment picture. We're not saying there's a current causation here by any means, but it's interesting to think about that currently the unemployment rate is higher for recent grads than for the all workers cohort. Could this be the start of a pullback in hiring due to AI and increased productivity from use of AI? We'll have to wait and see on that front. But in summary, tailwinds as we see them: one, incremental stimulus from the bill; two, Fed rate cuts potentially in the fall and winter; three, spending on AI. Headwinds to keep an eye out, also three of those: high deficits, which could simply be structurally here to stay; tariffs, number two; and number three, trade uncertainty. It's a lot for the equity markets to digest. I'm going to pass it to my esteemed colleague, Jim Lebenthal, to walk us through what's happening in the equity markets.
Amita, thank you very much, and welcome everybody. As this chart shows, the equity markets are digesting all the tailwinds and headwinds that have been thrown at it. If you've been with us for longer than a few months, you may recall that on April 8th, we did an ad hoc conference call. This was 4 trading days after the April 2nd liberation announcement. Purely by coincidence, it marked the lowest points in the equity markets as seen on these charts. And our message at the time was that if you look back on any financial crisis, any crisis that has hit the equity markets as hard as this one was hitting it, you see that inevitably the markets come back. That even if you had invested right before that downturn, that the returns over time are really quite good, and that it's just a question of how long it will take for equity markets to recover. Now, lest this sound like we're patting ourselves on the back, let me be very frank and say we did not think markets were going to come back this fast. We clearly thought that the downturn was overdone, and that they would come back, but this recovery has been dramatic, to say the least. It does speak very loudly to what we say all the time about not trying to time the market. I often wonder if we sound a little bit like a school marm when we say that, but the point is really made clear in how quickly equity markets have recovered this year, that trying to time the market is definitely dangerous. These charts, of course, also beg the question of what comes next, and we're going to try to answer that in the next few slides. At the very least, though, with equity markets at all-time highs just today, the fears of stagflation, empty store shelves, spiking interest rates, massive layoffs, etc., are at bay for now. The financial markets and the equity markets in particular are predicting good times ahead. Now, let's decompose the returns a little bit on the next slide, if we can, please. This is sector returns on a year-to-date basis. And I think it's important to talk about the fact that technology is not leading the pack. Now, 8.1% over just over 6 months is nothing to sneeze at, but it's good to see the leadership rotation. In the introduction, Tom mentioned that there has been still concerns about concentration in the rally, but let's put this in perspective. In each of 2023 and 2024, the market cap weighted S&P 500, which is the index that is most often quoted, outperformed the equally weighted S&P 500, which is a measure of the average stock, by 10 full percentage points, for a total of 20 percentage points over 2 years. So far through the first 6 months of this year, yes, the S&P 500 market cap weighted index is outperforming the equally weighted index, but it's only by 2 percentage points. And as we can see in this slide, there are strengths in other sectors of the market. It's worth pointing out that financials and industrials are at the top of the leaderboard. Those are sectors that are highly dependent on economic activity. And again, it's the equity market's way of saying that there is growth ahead. Also of interest is that utilities are at the top of the leaderboard. Normally, utilities are looked at as a defensive sector, but they've become a growth-oriented sector in the past few years as data center buildouts have placed a large demand on utility and power supply. So the fact that utilities are high on the leaderboard is not an indication of a defensive market, but frankly, a pro-growth market. Let's take another look at the leadership rotation on the next page, which shows the Magnificent Seven stocks. And in particular, it shows that they are losing correlation with one another. And this, to us, is good. It's another sign of the broadening of the rally, that all of the money is not just going into the largest mega cap companies indiscriminately in the market. But there's another thing to point out in this chart, and particularly if you look at the NVIDIA chart. Now, remember in January, the Chinese AI model known as DeepSeek was announced, and it was widely feared that that could be the end of the artificial intelligence trade. And you saw NVIDIA go down 30% in 2 months to a low of $93. But since then, there have been clear indication from major technology companies that capital expenditures on artificial intelligence build-out is continuing. Those data centers and the semiconductor equipment chips that go into them is continuing. So when we think about NVIDIA that was at $93 just a few months ago, it's now at $173. And again, I'm sorry if this sounds sanctimonious, but it really does paint the picture that trying to time the market is not a good idea. Staying in high-quality stocks through thick and thin is a better way of making money. But overall, the rally is broadening. And now going forward from this slide, let's try to answer the question a little bit more deeply of what comes next. What comes next depends critically on earnings growth, and that's always the case. But as we look at these earnings projections, it's worth pointing out that this year, the projected earnings growth is 9%. And in 2026, the projected earnings growth is 14%. So certainly we field a lot of questions about whether the market is too expensive. Trading at 21 times next year's estimates for S&P 500 earnings may seem a little expensive. It's certainly not cheap, and we're not going to try to say that it is. But relative to a 14% earnings growth, that's actually not too bad. And as we'll show in a moment, we're talking here about the market overall. Individual stocks are trading at very different valuations. Now, also, I think it's reasonable as we look at this chart to ask the question, are these growth rates feasible? 9% and 14% are meaningful earnings growth rates. From recent patterns of quarterly earnings, we think it is feasible. We would point out that earnings expectations for the past several quarters have come in much better than expectations. And early in this second quarter earnings season, we're seeing that pattern hold up. So even though expectations for this second quarter earnings season are for only 4.8% year-over-year growth, we think the results are likely to come in closer to 8 to 9% and promote the trajectory of earnings growth that is shown on this chart. And let's look at it with a little bit more granular lens on the next page, which shows how these earnings estimates have been revised over time. And you can see on the left-hand side that the annual earnings expectations have been revised downwards. That is almost always the case, but I think it's worthwhile pointing out that both on the annual level and the quarterly levels that are shown on the right-hand side, the earnings revisions have stabilized recently. So you can clearly see more easily on the right-hand quarterly chart that after the April 2nd tariff announcement, earnings estimates came way down. It's also interesting to note, though, that while they have stabilized or bottomed, they haven't yet started to go up. And again, we're early in this second quarter earnings season, but what we've seen so far from companies like Delta Airlines and the big banks is that earnings results are coming in much better than expectations, much better, which is a way of simply saying that these revisions downward in earnings expectations are probably overdone and there is room for them to be exceeded on the upside. Um, and let's go to the next slide, please. Okay, so on this slide, I want to start to talk a little bit more about that broadening of the rally and why we think it can continue. What we're showing here is the earnings growth rate for the Mag 7 stocks in the blue bars and the other 493 stocks in the S&P 500 in the tan bars. And what you can see is that there was a very good reason in 2024 and earlier for the Mag 7 stocks to meaningfully outperform. They had earnings growth rate that was far and away exceeding the rest of the market. But now what you're seeing so far this year and in the projections going forward is that that difference between the earnings rate is starting to close, and we expect it's going to continue to close, further promoting the broadening of the rally. And it's based on fundamentals that we'd like to show on the next slide in a slightly different way. I alluded to this just a minute ago when I said that if we're talking about the market overall at 21 times 2026 earnings or 22 times forward earnings, it's important to recognize that those multiples are inflated a little bit by those Mag 7 stocks. What we're showing here in the tan line is the earnings multiple for the S&P 500 as measured by the market cap weighted index, which is to say very heavily weighted by those Mag 7 stocks. When you look at the S&P 500 on an equally weighted basis, which is in the gray line, you can see that the multiple is much more forgiving at 16.9 times, very close to the long-term average of 16.4 times, which is certainly not expensive and gives room for the rest of the market outside of those Mag 7 stocks to perform nicely in the months and quarters ahead. This is not a call on our part to sell the Mag 7 stocks. We still think there is certainly a lot of progress to be made in the data center build-outs that promote a lot of the Mag 7 stocks, but we would simply point out that the rest of the market has room to catch up and that we think it will. Now, besides the broadening of the U.S. rally, let's talk a little bit on the next slide about the international rally, because certainly this year international stocks have had quite a run. Long overdue, after about 15 years of international stocks underperforming the S&P 500. But we can see here on this chart that it has finally, it being international stocks, they have finally started to outperform. And we think this outperformance can and will continue based on fundamentals, which we're going to show on the next slide. On the left-hand side, we're showing earnings growth of international stocks versus the U.S. S&P 500. And what it's showing is that 15-year, or at least 10 years as shown on this chart, era of underperformance was justified. The earnings growth rate in the S&P 500 was much greater than international stocks. However, we think that there is going to be an inflection upward in the growth rate of international equities by virtue of Europe in particular, but also Asia, getting the message that they need to spend more on domestic defense. And accordingly, you've seen countries like Germany take off some of the fiscal brakes that they've had on and start to issue debt levels that will allow them to spend on military and military-related projects that should flow through to better earnings growth for domestic companies in Europe, and the same thing in Asia as well. When you combine that with the difference in multiples between US and international stocks, as shown on the right-hand graph, it does give us the belief that the outperformance in international stocks this year is not a flash in the pan, that it has legs and will continue. I do have to point out, however, that this does not mean we believe American exceptionalism is gone. If you look at most of the innovative companies in the world, they do tend to be domiciled here in the United States, and we do expect that to continue. So all we are saying is that the geographic diversification that we have preached for many years, and which took a long time to show its benefits, is likely to continue in the equity markets for the foreseeable future. So it's not a time to give up on geographical diversification. With that, let's go to the next slide, please. And this is going to be our final slide for today before we go to the Q&A. What this chart is showing, obviously the S&P 500 over the last 10 years, but the red triangles indicate every day in which the market was at an all-time high. We often hear from clients, how can we buy the stock market when it's at an all-time high? Let me be clear, at Cerity Partners, we're not selling you anything. We're giving you advice. We're telling you what we think the markets will do. We don't have a crystal ball that perfectly predicts the future. But what the history of the markets tell us is that saying you don't want to own stocks because they're at an all-time high, or because you want to pull back, or you want to pull back on your equity allocation, again, because stocks are at an all-time high, is not necessarily the right way to look at it. As you can see here, 73% of the time from an all-time high, the next 12 months return is positive, which is basically in line with the long-term averages from any spot in the market. Now, those those one-year returns from an all-time high over the last 10 years have averaged 8.2%. So let me just say that again. On average, if you're buying the S&P 500 at an all-time high, for the last 10 years, your one-year forward return has been 8.2%, and that's really spectacular. Yes, it is below the overall average, which is almost by definition, which is 11.4%. But again, there is nothing about the market being at an all-time high that says you shouldn't own or buy stocks. With that, that closes our prepared remarks, and Amita and I are available to take questions, which Tom is going to curate from us, or for us, from the pre-submitted questions. Tom, back to you.
Thank you and Jim for your thorough tour of the global markets and economy. Jim, you touched on this a little bit, but maybe question that I think I ask you every time we do this, which is, can you provide a little bit more perspective on how you're thinking about industries and sectors and their participation in the continuation of the bull market in the back half of the year?
Yes. We currently are recommending a slight exposure to that equal weight S&P 500 that I mentioned. And it's our way of saying that we expect the broadening of the rally to continue. And what that means is that most sectors, if not all sectors, are likely to perform well going forward. As I said earlier, we're not making a call that we should sell the Mag 7 stocks or sell technology stocks. We don't think American exceptionalism is over, and it's expressed very heavily in those stocks. But we do see the grounds for a good economic growth story ahead. Amita went through some of the headwinds as well as the tailwinds. And overall, we think there's a reasonable chance that the economy continues to grow nicely, that inflation moderates, and the Fed can cut interest rates. If that's the case, sectors not related to technology, like financials, like industrials, which I mentioned earlier, should do well. If we continue to reshore industry into the U.S., we should see energy and materials pick up as well. And even if we look at some of the more defensive sectors like healthcare, what we see are very attractive valuations with good dividend yields that basically overall make us feel that all sectors are poised to do well, which is why we're recommending that equal weight S&P 500.
Thank you, Jim. I believe we covered most of the questions throughout the majority of the presentation. As a reminder, if there are any questions that we did not touch on, please reach out to your Sarity Partners advisor, and we're happy to answer those questions directly. I want to thank Amita and Jim for their great overview. Just to reiterate, we see substantial tailwinds at the back half of the year from the one big beautiful bill, the AI spend, which we believe is a secular theme supporting growth in the Mag 7, but beyond that. And finally, we see corporate profits in this backdrop of AI spending and the Federal Reserve moving from a hawkish to perhaps a dovish positioning, supporting corporate growth. There are risks to the global economy. The big, beautiful bill presents both opportunities and challenges. That challenge may come in the form of pressure on interest rates. And finally, we see tariff and trade policy potentially being a headwind to consumer spending and incomes, and also introducing continued uncertainty, which may slow capital expenditures in the back half of the year. Putting that all together, we remain positive both about the global economy and the U.S. economy. As Jim touched upon, while there are some headwinds from concentration in the U.S. market, we remain convinced we've continued in a bull market and believe there is an opportunity for diversification within international stocks. Thank you for your time today. Um, Please, if there's any additional information, visit our website, sariapartners.com. We have a lot of great information today there about the one big beautiful bill, as well as some other future pieces on specific items within the bill. Thank you and have a great evening.